Section 11. Role of risky lending practices. Don't default. As Melissa continued working with homeowners facing financial hardship, she began noticing a common theme. Many clients believed their financial problems were entirely their fault. One homeowner quietly admitted, "The bank approved the loan, so I assumed I could afford it." Later that afternoon, Melissa shared the conversation with David. "How did so many people end up with mortgages they couldn't afford?" she asked. David leaned back in his chair. "To understand today's foreclosure laws, you have to understand yesterday's mistakes." He explained that leading up to the 2008 housing crisis, many lenders aggressively competed to originate more mortgage loans. Some lenders approved borrowers with weak credit, limited income verification, or high debt levels. Adjustable rate mortgages with attractive introductory teaser interest rates became increasingly common. While the initial payments appeared affordable, many borrowers were unprepared when those rates adjusted upward, causing their monthly mortgage payments to increase dramatically. For many families, the payment shock became impossible to manage, resulting in missed payments and eventually foreclosure. Melissa nodded. "So it wasn't always that people were irresponsible." "Correct," David replied. "Some borrowers borrowed more than they should have, but some lenders also focused more on making loans than making sustainable loans." David explained that this period also saw examples of predatory lending, where some borrowers were offered loans with excessive fees, confusing terms, or products that were not appropriate for their financial situation. Realtors should understand these practices, not to assign blame, but to recognize warning signs and help educate consumers about responsible borrowing. While real estate licensees do not provide mortgage advice, they should encourage buyers to ask questions, compare loan products, and work with reputable lending professionals. Melissa then asked another question. If lenders knew some of these loans were risky, why would they approve them? David explained that many loans were bundled into large investment products known as mortgage-backed securities, MBSs, and sold to investors. Because lenders often sold the loans instead of keeping them, some had less incentive to evaluate whether borrowers could realistically repay them over the long term. As housing prices continued rising, many believed the market would continue growing indefinitely. Instead, when home values declined and adjustable rate loans reset, defaults increased rapidly, causing widespread foreclosures and significant market instability. Melissa remembered reading about neighborhoods filled with vacant homes. So one risky loan affected much more than one family. David explained that when thousands of homeowners defaulted, foreclosures increased, property values declined, lenders experienced major financial losses, and the broader economy suffered. The housing bubble burst, resulting in one of the most significant financial crises in modern history. The lesson for today's real estate professionals is that responsible lending protects not only individual borrowers, but also entire communities and the overall housing market. Melissa then shifted the conversation. Can someone with poor credit still qualify for a mortgage today? They can, David answered, but today's lending standards are much different. He explained that lenders now evaluate many factors beyond the credit score alone. Stable employment, verified income, debt-to-income ratio, available assets, larger down payments, collateral, or a qualified cosigner may all influence loan approval. Some borrowers also establish credit through secured credit cards, credit builder loans, alternative credit reporting, or consistent payment histories before qualifying for a traditional mortgage. These additional underwriting standards are intended to reduce lending risk while still providing qualified borrowers with opportunities for homeownership. Melissa smiled. So, today's goal isn't to keep people from buying homes. No, David replied. The goal is to help borrowers purchase homes they can reasonably afford. He explained that after the financial crisis, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act, which strengthened consumer protections and led to rules requiring lenders to make a reasonable determination that borrowers have the ability to repay certain mortgage loans. Regulatory agencies such as the Consumer Financial Protection Bureau, Federal Reserve, FDIC, OCC, HUD, and state regulators continue overseeing various aspects of mortgage lending and consumer protection. Realtors are not expected to enforce these laws, but understanding why they exist helps explain how today's lending environment differs from the years leading up to the housing crisis. As Melissa finished her notes, she realized that understanding risky lending practices wasn't about reliving history. It was about recognizing how responsible lending, careful underwriting, consumer education, and ethical real estate practices all work together to reduce defaults and protect the public. Every realtor has an opportunity to encourage informed decision making by helping clients understand financing options, referring mortgage questions to qualified lenders, and avoiding statements that encourage buyers to purchase homes beyond their financial means. In the next section, we'll examine the legal protections and consumer safeguards that were created after the housing crisis and how they continue to influence today's Arizona real estate transactions.